Am I audible? Please respond so that I can start the class.
Yes, Ma, you are audible.
All right. Okay. Okay, fine. So let's start the class. Today I am going to discuss the part financial management. Uh, till the last three classes, we have studied accounting, how to prepare and journalize the entries, then how to prepare the ledger accounts and trial balance, and finally, how to post the entries into final accounts, that is balance sheet, and how to interpret the balance sheet. Now, today we are going to discuss the part that is financial management, that is the second part of your MCS 20 to 25 course. So, let's begin with the basic definition of financial management. I am going to share the screen. Is the screen visible? I hope the screen is visible. Is it?
Yes, Ma, it is.
Okay. So, financial management, as the name suggested, this is the combination of two words, that is finance and management. Now, finance means money or maybe the cash, and management means how to manage the cash. But if you talk about the entire financial management function, then it is not only uh, that how to manage the fund. Rather, the job of financial manager starts when there is certain project or certain business the organization has to take up. So the job of financial management starts by identifying the opportunity of business. All right. So in the business world, you may have two, three, or four choices together, four or five projects together. So the job of financial management is first to calculate the gain or loss or risk associated with the projects and identify which one will be beneficial based on the risk and return analysis. Now, once the project is identified that a particular project is good to invest, then the second question arises that how much fund or finance is needed to run that particular project or to run or to meet that opportunity. Now, once the cost sheet or the budget or the tentative cost sheet is prepared, then the third question is, let's say the requirement is already analyzed and a certain amount is being identified that this is the amount or this is the finance needed to run this particular project. Now, the third question is how much internally the money can be managed. All right. So, not necessarily the entire fund or finance you need to bring from outside. So, the first question is to see the calculation at what point of time how much money is needed. All right. Once the need is analyzed, like the complete fund may not be needed once, so it will be needed in a fraction of time, but it will be needed uh, in an installment. So maybe big at the beginning there would be certain amount, then certain amount for running the project, or that analysis has to be done by the financial manager that at what point of time how much finance may be needed. And then the analysis also should be that how much internally can be managed. Now, if that analysis took place, the financial manager also would be able to calculate that how much finance is not manageable by the internal arrangements. Now, that money has to be arranged from outside. Outside means from the external sources, either by issuing shares or by issuing debentures or maybe by taking loan from the financial institution. And then the manager or the financial manager also has to calculate that which is the cheaper source or which combination of the sources would be the better source to grab the capital from the market. So maybe they will also analyze the cost associated with each source and the risk associated with each source. All right. For an example, just say right now I have given an example that the company may get or arrange finance by issuing shares, also by issuing debentures, and also the company can take up the loan. All right, so if I am talking about these three major sources, there are certain risks associated with each kind of source of finance. Let's say the company is issuing equity shares. Then what will happen that the company will pay a certain percentage of income or net profit as dividend to the shareholders. And the good part is, if the company doesn't have profit, then the equity shareholders won't get anything. All right, so that way it is cheaper because if the company is not earning a good profit, they don't need to give anything. And if the company is earning a good profit, they will give the dividend. But in the second part, on the contrary, you can see that if the company issues equity shares, that means the company will be in lifelong debt. Like whenever the company would be flourished, financially strong, they cannot pay back to the shareholders the principal amount, and the company won't be declare itself debt free, even if the company is financially sound. So once the shares are issued by the company, generally it floats in the market from one shareholder to other shareholder. So the company has to be in the lifelong debt and keep on giving dividend across the years. So that is the risk associated with equity shares. Now, talking about the dividend, if the company issues dividend, the company is liable to pay up for a certain percentage of interest. And after a certain period of time, the company has to pay back the principal amount too. Now think about if the company is issuing debentures in the market and company's financial situation is not that good, it has not started earning by that particular project, the company has to compulsorily bear the interest they have promised to. All right, so it is another financial burden on the company. Similarly, if you are talking about a bank loan, then you need to arrange mortgage, you need to pay monthly interest to the bank. So each and every financial resources has a cost, that is known as cost of capital. So the financial manager need to analyze from which source the money need to be borrowed and which will be the best option according to the situation. So this is the entire task of financial management. So you may be asking that what is the financial management of finance? No, it starts when there is certain project is knocking the door. The job starts from there. To analyze whether to take up the project or not, whether to move ahead with the expansion of the business or not, how to make sustainable business, and then to access the need of finance, and then to access the need of finance, and then to analyze at what point how much money would be needed, then to analyze how much internally can be managed through the receivable management, and at last when you can actually calculate what amount of finance cannot be internally managed, then you need to analyze what are the opportunities externally available with the company. And then you need to also analyze the risk and return associated with each and every opportunity, and then finalize from which source actually you can bring money to the organization. That is all about financial management. I hope the definition is clear. If you go through the screen, here some definitions are reflected. Like Solomon says, it is concerned with the efficient use of an important economic source, namely capital fund. So here the Solomon focuses that whatever the money you do have in the business, how effectively you can use it, that is all about financial management. Whereas SC Kuchal says that financial management deals with procurement of fund and effective utilization of fund. Here in the next slide, you can see there are few more definitions which are in and around the explanation that financial management is all about the calculation, how much procurement of fund is needed, and how the fund would be effectively utilized so that the return guarantees, or you may earn more than the cost of capital associated with the fund. Now, by looking at the definition, I can tell you these all are the summarized objectives of financial management. First, to ensure that the adequate fund or the regular supply of adequate fund is available. So, the job of financial manager is to ensure that the required money is always available within the organization so that there is no interruption in the business. At the same time, the financial manager also has to ensure that there should not be deficit of fund or excessive fund. So they have to always keep arranging the adequate fund for the business. That is why the second objective also says to provide fair rate of return to the investors. It is the job of the financial manager to give a fair return. Why I am talking here the fair return? Fair return means the average return which is given by all the other organization or the other similar organization. Otherwise, in future investors may not be ready to invest in your organization. So you need to give a good return to the investors, that you need to ensure. And then you should also ensure that whatever the money you brought into the business, it is effectively utilized. There should not be any wastage or excessive use of money. The fourth one is you need to minimize the cost of capital. That means whatever the interest or dividend that you are promising to pay in return of the capital, that has to be minimum. So you need to ensure from which source the cost of capital would be minimum. And the last one, to coordinate the activities of the financial department with the other departments. Like each and every department needs fund for the operation of their activities. So how would you create harmony? How would you create sync, or you can say alignment between different departments? How would you distribute the fund? How would you create a good relationship and smooth execution of the task? That is the job of financial managers. So these all are the objectives. Now, talking about the two basic objectives of financial management, based on these all tasks, so we can say these are the two schools of thoughts which we can summarize based on the definitions given by different economists, that financial management objective can be of two types. One is profit maximization, second one is wealth maximization. So profit maximization is a narrow concept, which is a older concept. Right now people doesn't believe in profit maximization, because profit maximization says that every financial management or the manager's objective is to earn more and more profit. Of course, it is true that every organization or every financial manager put their effort for the maximizing of the profit. But I'm sorry, I think screen is not shared. Is it shared now again?
Yes, ma.
Okay. So, profit maximization says that the financial manager's entire effort should be to earn more and more profit. Whatever is being invested, by that investment, the managers has to ensure more and more profit. But the argument which is against this profit maximization concept is, let's say you are focusing for maximizing your profit, that means uh, you may compromising with the quality of the product, or maybe quality of the work atmosphere of the laborers and workers and employees. Maybe you are not ready to pay a very good salary, or you are not motivating your employees because you don't want to spend on these affairs, rather you are focusing for gaining more and more profit for the organization. So in the long run, what will happen that you may earn a good profit in the shorter run, but in a longer run you are just making unhappy to your stakeholders. And if you are doing so, you are making your stakeholders unhappy. What will happen? The investors will try to withdraw their amount, the employees will try to get a new job, the laborers may not be ready to give a very good output. Maybe the customers will also be not happy because you have started compromising on either quality, or you are not spending on research and development of the product. So in a long run, profit will automatically reduced. So you cannot say that the profit maximization can be a correct objective for any organization, because it is applicable only for the shorter run. In a longer run, profit will automatically reduce because you are focusing only on earning money, but you are not ready to spend money on the welfare side. So that is why this profit maximization concept is challenged by few of the economists, and they came up with a new thought, new school of thought, that is known as wealth maximization. Now, this wealth maximization concept says any organization should not have objective of profit maximization, rather they should have an objective of wealth maximization. Now, what this wealth maximization means? It means to keep all your stakeholders happy. Okay, so that means you are earning a good income, at the same time you are focusing to give a very good dividend and interest to your investors. You are also working for the employees welfare. You are also spending some money for the development of the product. You are also spending uh, asking in the product. So these all are the aspects you are just addressing too. So here you can see, if you are addressing each and every aspect or each and every stakeholders aspect, then in a longer run all the stakeholders will be happy, and it will give you more and more business, and ultimately you will earn more profit. So these are the two concepts. Right now, in the modern era, we focus in the wealth maximization concept rather than the profit maximization concept. Okay, now profit maximization has their own favorable and unfavorable argument. Like the favorable argument says profit should be the only motive. Otherwise, why people are doing business? If profit is not being earned, how you can keep your stakeholders happy? You need to earn money. You need to calculate your success in terms of money. These all are the favorable argument. And unfavorable argument, as I said, that profit maximization will not sustain in a longer run. Rather, in a longer run, what will happen, that your stakeholders will be unhappy, and you need to again focus on the wealth maximization concept. Similarly, the wealth maximization also has certain favorable and unfavorable argument in favor, argument against. So argument in favor is wealth maximization means sharing your profit with everybody and keeping everybody happy. So if stakeholders are happy, your business is going to flourish. So you are addressing each and every stakeholders issue. So you are utilizing your time, you are utilizing your money, and that money will bring you success, and you are working for your society too. So this is a favorable argument. Unfavorable argument says how you can keep your stakeholders happy if you are not earning profit. At the end of the day, you need to earn more and more money to address each and every issue. So management cannot control any stakeholder or the happiness of any stakeholder unless and until the profit is being earned or the high profit is being earned. So the ultimate goal or ultimate objective should be to earn more money, and then only you can talk about maximizing the wealth. So these all are the favorable and unfavorable argument related to financial management. Talking about the scope where the financial management can be used, so it can be used by economists in the economic, because financial management is a huge part of economic, that economic policies deals with the fund or money or the effective utilization of money. So economists can use the financial management technologies, financial management thoughts into economics. It is also accounting, because each and every calculation of financial management is in form of accounts. It is mathematics, because the calculations are also available here. So mathematics like correlation, regression, analysis, and over to understand the relationships between different variables. Financial management is also production management and human resource management, because depends on how much money is available, how much depends on how much money is available for this particular task like production and human resource. The HRM or the people associated with production has to build the strategy to smooth execution of the production or the human resource. So these all are the scopes. All right. So when we talk about these four basic function or basic decisions related to finance, as I said that financial management has four major decisions to take. One is whether to invest money in a particular project or not. So they need to analyze the project, they need to analyze the opportunity, what will happen if they drop the opportunity, what will be the scenario if they opt for the opportunity. That is investment decision. Then the financing decision is all about how much money is needed, how much, at what point of time is needed, on that particular point of time, how much internally will be available, how much won't be available. If that is not available, what are the resources or sources by from which the money can be taken, debt can be taken, and how to minimize the cost of capital. That is financing decision. The third one is working capital decision. So working capital is an entire chapter you would have in your subject MCS 225. So working capital means the capital or the fund needed to run the business, daily business needs. All right, so the all the short term needs has to be fulfilled by working capital. So you need money for long term as well as for short term. So investment decision and financing decision is always is a factor which deals with the long term requirement, whereas working capital decision means how to meet the short term financial obligations. And the last one is dividend decision, which says that after earning the money, how much you are ready to return or how much you are ready to give to your shareholders as dividend, as a part of profit. So these are the four major decisions related to finance. Okay, I am not going with this part. I think this part is either not available, or you can all study what are the jobs of financial manager. So financial manager, just I'm reading it out, you let me know if you have any doubt in any of the point. So financial manager's job is to plan for the finance, forecast the need, then grab the fund, acquire the fund, then allocate the fund to the different departments, then ensure effectively the fund is utilized, then disposal of profit means divide the profit among the shareholders and ensure the maximum maximization of shareholders' wealth. May I know, do you have any confusion here? It is the job of financial manager, the person who manages the finance. I hope till this point it is clear. I am going one sided, I am not listening to you. May I hear from you? Are you able to understand? Okay, Sylvester is saying yes. Anyone else? Till this point, financial job of scope of financial management and the function of financial manager. Is it clear? Shall I move ahead? I hope others are also listening to me. Okay, sure, sure. Okay, so moving ahead, these all are the financial managers function, and then there are a few more like interpret and report. To whom the financial manager reports, the reports to the board of directors, because financial managers are the salaried people. They cannot take decision, they can just advise what decision to be taken by the managers related to finance. So the financial managers also reports back to the management. Then the legal obligations. So any legal hurdles or obligations faced by the organization has to be dealt by the financial manager. They have to also, the financial manager, if they feel that they are unable to interpret certain data, they can also take some professional advices if needed on behalf of the organization. Okay, and at the end of the day, financial managers are answerable not only to the management, they are also answerable to all the stakeholders. That why the salary has not been increased. If increased, what is the policy behind it? How the salary has been decided? They need to answer. They need to answer to the shareholders why the percentage of dividend which is being distributed among the shareholders. Why is it that? What is the plan if they are not giving good dividend? What is the plan if they are giving a very good dividend? Why they are not saving money for the future expansion? These all answers has to be given by the financial manager in form of a report to all the stakeholders. So these all are the functions of chief financial manager. Now this is the next topic that you have in your fourth block, that is capital structure. Now, capital structure, as I just explained you, that if you need to bring capital, there are four sources. Okay, there are four sources. These all are the four sources. First are the equity share capital. You can issue equity shares in the market. Then the preferential share capital. That means you can also issue preference shares in the market. Now, what is the difference between equity share and preferential? Equity shareholders will get dividend when the company earns profit. Equity shareholders will not get anything if the company is in loss. Equity shareholders won't again get anything if the company is in no profit no loss situation. That means the dividend of equity shareholders highly dependent on the growth of the company. So let's say I have purchased some shares, then I need to observe whether the company is earning any profit or not. If the company is earning profit, then only I will get opportunity to get some money as dividend, otherwise not. But preference shares are different from equity shares because preference shares are costly. At the same time, with the preference share, there is a guarantee that certain percentage of the value of the share will be given by the company just like in form of interest. So generally you see the name of the preference shares are like this: 6% preference shares. What it means, that whatever is the value of that share, with the you can calculate the interest you are going to get at the end of the financial year. So you are going to get 6% of the amount. Let's say I have purchased one preference share and the value of that preference share is 1000 rupees, and it's a 6% preference share. That means I am going to get 60 rupees. All right, 60 rupees as dividend, and that is assured money. Even if the company is in a loss, not earning anything, preference shareholders will get at least the interest. Preferential holders, shareholders will get many more if the company is doing good. Then the third opportunity to grab the fund is reserve and surplus. So reserve and surplus is the money which is saved by the company in the previous financial years from the net profit. So every year the company earns some profit, and out of that profit company spends something and company keeps something, some money as reserve. So that reserve fund can be utilized at a later stage rather than getting fund from outside. And the fourth opportunity to get capital is the borrowed fund. That means borrow money from financial institution or issue the debentures. So these all are the long term sources of capital. So what capital structure means? Capital structure means uh, the combination or the mixture of debt and equity that the firm is using to meet the financial need. So every company would issue some preference shares, some equity shares, some debentures, some money can be arranged from retained earning. All right, so that mixture is known as the capital structure of that particular company. Let's say if I say that a company has a capital of 1 lakh rupees. Out of that 1 lakh rupees, 20,000 is arranged from preference shares, 20,000 from equity shares, and rest of 60,000 from retained earning. That means their capital structure is preference share, equity share, and retained earning, and the ratio is 2 is to 2 is to 3. Sorry, not 2 is to 2 is to 3, it will be 1 is to 1 is to 3. So this is the actual ratio which explains the capital structure. So capital structure is nothing but the debt and equity mix for grabbing the public money or outside fund by the company. Okay, now what are the factors that influences capital structure? So what are the factors that identifies how much money is needed and which are the opportunities? So fewer internal within the organization, fewer external outside the organization. So the nature of the company decide what fund you are going to get. So if your company is not a registered company, rather you are having a partnership firm, you cannot issue shares in the market, because shares only the joint stock company can issue, those who are registered under SEBI. So you cannot issue. So that opportunity is not available with you. Similarly, if your size of the organization or business is very small and you are in the initial phase, bank is not going to entertain you, and bank is not going to grant any loan to you. So you need to believe on your friends and family for borrowing the money for your business. So similarly, if the business is seasonal, then the more fund is needed during the peak hours, and during the season when the business is not really being done, then the funds requirement is minimum. So these all are the internal, and external depends on uh, the country's availability of fund, availability of banks, the rate of inflation, the economic structure, the kind of investors available. These all are the external. So based on this entire internal and external, company decides what capital structure actually they need. Okay, now optimum capital structure, always in your question paper you will see what are the factors decide the optimum capital structure or optimal sound capital structure. So optimum capital structure is not a particular mix of debt and equity which is propounded by any economist. You cannot say that 50% debt and 50% equity is a very good optimum capital structure. You cannot say you should take 10% debt and 90% you should manage through shares. That is also wrong. So what is optimum capital structure? That depends upon so many things. But in short, we can say optimum capital structure is a structure where you need to give a minimum return, you need to bear a minimum risk, and you are getting a maximum fund by that particular capital structure. So where the cost of capital is minimum, the value of the firm is increased, you are getting an opportunity to get the entire fund which is required, and you are minimizing the cost, is a good optimum sound capital structure. So that the financial managers decision how they would create a optimum capital structure. So optimum capital structure must have these features. It has to be easy, simply calculated, the risk has to be minimum, the cost of capital has to be minimum, there should be simplest rules, stakeholders are happy but still you are not paying a very high dividend, so cost is minimized, risk is also minimized, still you are getting your fund on time, is a optimum capital structure. Okay, if you are that legal procedure should be easy to carry out, like you are keep on working on the legal papers and you are not able to get money from outside, keep on filling out forms after forms, will not work. You need to bring immediate capital to the firm, otherwise you may lose the opportunities. So you need to also see the legal requirements has to be minimized, there has to be flexibility, unnecessary restrictions by the government should be avoided, and there should be sufficient liquid cash. These all you need to be ensured. All right. Here are few capital structure theories like net income and net operating income. Here, these two capital structure theories are propounded by David Durant, which says that if you keep your debt minimum, like you are issuing shares maximum and you are taking a very less debt from the bank or issuing debenture, your value of the firm is going to be increased. This is the uh, theory propounded by David Durant. But in the second theory, which is also propounded by David Durant himself, says that the firm's value is not affected by the cost equity ratio. So both the theories are propounded by David Durant, and David Durant has got Nobel Prize for both the theories. First theory was propounded much ahead, but again he has changed his theory and come up with a new one, which says doesn't matter in a long run how much you are earning through debt and how much you are earning through equity. Ultimately, your capital structure should ensure that the required money is available and the cost of capital is maximized. So, this is going to be asked in your theory. All right. So, be very sure that you are going to get one question in your university exam that define financial management, what are its characteristics and objectives, what are the job of financial manager. You definitely get a question in the university exam, and you also get a question that what do you understand by capital structure, how the optimum capital structure may be decided, and what are the key features of an optimum capital structure. These two theories are propounded by David Durant. So that is why I tried to just focus on these two aspects. Now if you are clear, I would try to move out with cash flow statement and fund flow statement. At this point of time I would like to ask you whatever I have explained, do you have the clarity? Sylvester, the class is not yet end. So I am going to teach you, just asking if you have any query or doubt at this point. If you are able to understand what I taught, then I would like to teach some numerical of cash flow statement and fund flow statement at this point. Mr. Wajhu Usman, are you able to understand? Yeah, Sylvester is saying please proceed ahead. What about others? May I proceed ahead? Are you all able to understand? Okay, Anas is saying it is clear. So may I expect that all are clear and I can move ahead, because I need to teach cash management. So that's why I just wanted to know that financial management, the basic theory is clear or not.
Yes, Ma, it is clear.
Okay, fine. Fine. Then I would like to again move ahead. Now this is cost of capital. Cost of capital I have already explained. Just one slide I would like to focus it here is cost of capital means the cost that you are bearing to bring the capital. Let's say you borrowed 100 rupees from somebody and you promise to give 10% interest. So that means that 10%, 10 rupees is the cost of borrowing that particular 100 rupees capital. So cost of capital is nothing but the value that you are giving back or you are foregoing by using the money. All right, so let's say that you have 100 rupees in your pocket and you have two choices: either you spend it or you can keep it in your bank account. You have opted for the second choice, that you would like to keep it into the bank, and bank promised you to give 4% interest. That means you forego to spend 100 rupees and you have invested it in the bank account, you have saved it, and that's why you are eligible to get 4 rupees as cost. So that 4 rupees is your cost of capital. Similarly, suppose you bring money from somebody and for that you are paying interest, is the cost of capital. Suppose the company is issuing shares and for that the company is paying dividend, the dividend amount is the cost of capital. So cost of capital is nothing but the return or the minimum return that the company has to give for borrowing the money or for taking the money from the outside sources. This is just for your information. So we can calculate this many cost because we can get the public money from these many sources. Cost of debt means cost of uh, debt, getting a debt from bank or by issuing debenture. Cost of preference shares, suppose you are issuing preference share, what dividend you would like to give, that is the cost of preference share. Cost of equity share means the dividend that you would give to the equity shareholders. Cost of retained earning means your own earning or your own profit that you have saved and you have taken the option to again reinvest it in the business. So you have not kept it in other sources. So by not keeping in other sources, you are losing some money. So that is the cost of retained earning here. Working capital management is an another section. You are going to get a theory question to answer from this particular section, working capital management. So listen it very carefully. In a business, two types of capitals are needed. Okay, one is long term capital, one is short term capital. So whatever we have studied at this point is about the long term capital, means the money which you are receiving for more than 1 year for a long term. Okay, so the long term capital can be arranged from shares, debentures, retained earning, and one more source is long term loan. Okay, but these money only you can use for long term sources, like for establishment of fund, buying machinery, for establishing the business. You are not permitted to run the daily business with this fund. That is government's restriction. So the rule says you can borrow public money, but public money cannot be utilized to run the business. Rather, it can be utilized for the expansion of the business or establishment of the business. So, how to arrange the money to pay the labor cost? How to manage the money to buy raw material? How to manage the money to pay electricity bill or stationery bill? Because these all are the basic need to run the business. which are which falls within the year, to pay the rent, to pay the salary, to pay the commission, to pay the labor cost, to buy raw material, okay, uh, to pay the electricity, water, coal, gas, repair and maintenance. So how to meet all these expenses which is occurring in the business for a daily for in a daily business on a daily basis. So these are called the short term requirement of capital and also known as working capital. So working capital refers to the capital which need to meet the short term financial obligation of the firm. Okay, so short term means here less than 1 year. So you can say working capital refers to the capital which is required in the business to meet the daily expenses or short term requirements. Okay, so with this working capital you need to buy the assets which is short term assets like raw material. You need to buy small goods which will be needed, just like current assets and current liabilities has to be dealt by working capital. But at the same time working capital cannot be arranged from outside fund. So how you are going to arrange it? You are going to arrange it by taking debt. Okay, so you are promising to pay at a later stage when you are generating money. It's a very famous way of managing working capital. Do not pay at later when you are earning. You can also borrow money from your friends, from your family. You can sacrifice your own personal savings. That are the ways of arranging working capital. And at all, if you need to arrange it from outside, you can take short term loan like a loan for less than 1 year from bank or financial institution. So these all are the way of arranging working capital. Okay, now working capital is how much working capital is needed for a business dependent on the operating cycle. Let's say that my business, I am a manufacturing unit, so this is the cash I do have for starting my business, and by that cash I purchased raw material. And after purchasing the raw material, what I have done, I have account payable, means I need to pay some amount to the people from which I purchased the raw material. Then what happened? After buying the raw material, I processed the product. It is YIP, work in progress. So with the material, I start preparing the product. It is in progress, not yet finished. Then at this point of time, some value of the product is added in a complete process. Now, after work in process, the next step, the goods are being finished. That means the goods are manufactured. So, from cash, there is a journey of buying raw material. After raw material, there is a journey to process the product and finally finish preparing the product. Then, what will happen? I will sell my product. All right. Now, what will happen? After selling the product, I may not receive the immediate cash, so it may be account receivable. At a later stage, I will pay my account receivable. Then, what will happen? After paying the account receivable, I will get the amount back. So, this is how working capital works. I will get the amount back, and finally, I will pay my account. If maybe tomorrow evening 5 o'clock, I will be able to generate the cash, because I will buy raw material at 8 o'clock in the morning. I will start preparing the chocolates 9 o'clock in the morning. Maybe by evening I will finish preparing the chocolates. Then what will happen? After selling the product, I may not receive the immediate cash. So it may be account receivable. At a later stage, I will pay my account. So this is how working capital works. Now, working capital is 2 to 3 days from cash to cash. So here you can say the requirement of cash is minimum, because once I generate the cash, it is preparing the immediate requirement of the business. So this is how working capital works. So in that case, again, I can start buying raw material. But cloth, how much demands on that case? The working cycle would be so depend is you need to thing. There are two basic definitions of working capital. One is gross working capital, one is net working capital. Gross working capital is what fixed working capitals are also needed to run the daily businesses. Okay, so here I am also going to discuss what are the disadvantages of inadequate working capital. Let's say there is always a shortage of working capital. What will happen? The first thing, if you do not have excess liquid money, you will stop paying to your creditors. And if you stop paying to your creditors, creditors will also stop giving you credit. So your business will be in extreme loss. The second thing is, if you are missing to pay your creditors, that means creditors will also stop supplying material. It will happen that more assets and so you need to minus it from the assets. And then the last two formulas related to liabilities. Now think it very clearly. I am giving you one example. I went to the shop, I purchased something, and I said I will not pay right now, rather, I will pay after 2 months. Okay? But I have purchased the goods and I promised to pay after 2 months. Okay? After some days, again I went to the shop, again I purchased something, and again I promised that I will not pay now, rather, I will pay at a later time. Now, what is happening? My liabilities are increasing, the amount which I need to pay back is increasing, but right now, as I have not chosen to pay, okay, I am not losing my present time. I am choosing to pay later option. So that is why this particular formula says if your liabilities are increasing, that means you are not losing your cash. So you add that amount with your account. That means your cash will still remain in your business. So you add that amount with your account and you have that cash within the business. Similarly, if your liabilities are decreasing, that means that you are paying your bills. That means you are losing cash. So you minus that amount. So you have a formula for current assets and current liabilities. When you prepare or whenever you will prepare the cash flow statement, you need to remember that formula. Sorry, add increase in current assets and increase in current liabilities minus increase in current assets and decrease in current liabilities. I am requesting everybody to take a screenshot of this formula. It is needed. For the operating activity, the formula says decrease in current assets, increase in current liabilities, minus increase in current assets, decrease in current. All right? Now this is investing activity. So this is the second activity which deals with the fixed assets part of the balance sheet. So here I can see, as I have already indicated, that if you are buying new material or you are buying new assets, that means you are losing money. So that is a minus figure for you. And if you are selling assets, it's a plus figure for you because you are generating cash by that. So these two are the formula, that in case of purchase the cash is going out, in case of sales the cash is coming in. So that is how it is plus and minus. And the last one, sources of finance. So here I can see all the sources of finance, like issue of shares, ventures by which we are issuing the shares, issuing the debentures, or we are taking. So we are generating cash by that. So this is a minus figure for us. So it is going to be minus figure for us. So this is the complete formula of cash flow statement. I am ready to give you one example of cash flow statement. Before that, just a 1 minute break, and please share if you have any question related to the subject, related to your exam, or else just after 1 minute break I will share one cash flow statement, how to prepare it. Just one for just one for if you have no question, then I can start. I generally don't give time at the end of the session, rather in between the session. Immediately, if you have any question in your mind, you can ask. Are you enjoying these sessions? Are you able to understand? Because this is something different for you. You are science background, right? All the students are from science background. So are you enjoying, or are you getting trouble in understanding? No trouble. Sylvester is very prompt answering my all the questions. Others are not answering. Yeah, you are getting. Thank you. So let's have a quick look how to prepare the cash flow statement based on the rules which I have just discussed. So this is a question. The balance sheet, all right. And if you see the balance sheet, here the clear mention of current assets, current liabilities, the fixed assets, and the share capital. Now, how to do it? The first, we need to see operating activities. Operating activity means all the current assets and current liabilities. And the formula is increase in current assets, we need to minus, increase in current liabilities, we need to add, decrease in current liabilities, we need to minus. So let's write it first. Current liabilities. As we know, current liability, if it is increasing, then plus, decreasing means minus. So here I can see from 20,000 to 18,000 it is decreasing. From us it is a minus figure. Okay, bills payable is again decreasing. So again a minus figure for us because the person is paying, the company is paying. So minus 8,000. Just denote it. This is just for understanding. So these liabilities are paid 8,000 at 2,000. So it is minus 8,000 and minus 2,000 for us. Now the stock from 2,000 to 3,000 means the more stocks has been purchased. So the cash is going to be reduced by minus 1,000. So here I can see from 2,000 to 3,000 means the more stocks because we have purchased more stock. Debtors are reduced, that means we can assume that, so it is a plus, sorry, plus 1000, because we have received some money at least. And cash we will not consider right now because this is cash flow statement, so I'm going to tell you at the end how to write it. So I have all the figures with me: current assets and current liabilities. And this is how I need to draw a format cash flow statement. So first we need to write the net profit for the year, but in this question there is no net profit, so no question of writing net profit. Then we have decrease in debtors. See, as I have already mentioned, debtors are decreased by 1000, so that is a plus figure for us. So here we will mention this 1000. Decrease in trade payable. Now trade payable is decreased by 2000, bills payable by 8000. So these are the minus figure for us: minus 2000 and minus 8000. Sorry. And increase in stock by 1000, so that is also minus 1000. So after calculation, I get to know that cash flow statement from operating activity, we have received 1000 rupees from debtors, but we have paid 2000 to trade payables. We paid to bills 8000 to bills payable, and we paid for buying stock. So what is the ultimate result? Plus 1000 and minus 2 minus 8. So minus 2 and minus 8 is minus 10, and minus 1 is minus 11. So minus 11 and minus 1000, and if you conclude it will be minus 10,000, the outcome of all this calculation from the operating activity. So this is the way you need to write it, that this is the outcome: cash used in operating activity minus 10,000 at the outer column. Now the investing activity. In the investing activity we consider all the fixed assets. So let's refer the building. Earlier the building was of 1,20,000 and right now it is of 1,08,000. That means you can find that the value of building is reducing. That means some building has been sold out. So if you are selling out the some building, that means you are generating cash of 12,000. So it's a plus figure because you are selling out the building. Machinery is of 40 to 36,000, and as there is no information related to depreciation, we will assume that there is a sale of 4,000 rupees. So again, 4,000 rupees cash is all the places we are earning cash. 12,000 plus 16,000. So this is my investing activity. Sale of building is 12,000. Sale of machinery is 4,000. So altogether again, by investing activity, I get to know I have generated this 16,000 rupees cash. Now see, in the operating activity I lost money 10,000, and to meet these expenses I have sold out some fixed assets and generated 16,000 cash. Now the last section is financial activity. So the financial activity here is only the capital. So I can see earlier the share capital was 1,40,000. In 2013 it is 1,60,000. That means more issue of share capital means more money into the company. So we can say that another 20,000 rupees are received by the business by issuing the shares. So here also we are generating income by issuing shares. So this is the financial activity and the only financial activity, because it's a very small question. So the outcome from the financial activity is plus 20,000. Now look at the outcome. I have, in the working capital was less. So within the year, if you see that the debtors, from the debtors we have received 1,000, but we have paid to the trade payable, we have paid to the bills payable, and we have purchased stock, and that is how we have a deficit of 20,000. 10,000 rupees, working inappropriate. And to meet this deficiency, what the company does, company has sold out the fixed assets, which is another bad impression. You should not sell out the fixed assets to meet your daily obligation. And then finally the company also issued the shares to meet the financial obligation. So whatever is the outcome, let's discuss. So the final outcome, minus 10 plus 16. So if you conclude minus 10 and plus 16, so plus 6. Plus 6 plus 20 is plus 26,000. So that is how the cash become, means after paying out the debt, still 26,000 was left. And as the previous year's class was 4,000, there was already a opening balance of cash was 4,000. That is why the closing balance is 30,000. Now this 30,000 you will see in the question. See, it is reflected here. So you can, right now you can have the explanation of how your cash from 4,000 rupees was left. The business had 30,000 rupees in its hand. By operating activities, loss of 10,000. To meet these losses, the company has sold out the building and machinery and generated 16,000 cash. Further, cash has been generated by issuing the shares. So after meeting the short-term obligation of working capital, still 26,000 cash was left. As the previous cash available was 4,000, that is why the present cash position is 30,000. So this cash flow statement is nothing, is a statement which reflects about the journey of cash flow from previous year to the present year. How and why the cash balance is that what is being available in the balance sheet. Okay, so that is how you can prepare your cash flow statement. And if I am talking about your assignment and your examination, generally three numericals or the four numericals are generally asked. First is journal entries. Definitely you are going to be asked in your assignment also, in your final examination also. You need to prepare journal entries, ledger and trial balance, one balance sheet to be prepared in the final examination as well as in the assignment, and one cash flow statement. So today we have just came to know how to prepare the cash flow statement. You have few questions in your blog, you can further refer those questions to know more about cash flow statements. Tomorrow will be the last day of preparation of cash flow statement. So today we have just came to know how to prepare the cash flow statement. You have few questions in your blog, you can further refer those questions tomorrow. If you have any question, you may ask. I am open to answer your question now. I am done for today from my side.
Hello, ma'am.
Yes, yes, Anas.
Uh, yes, I need still need more explanation about the preference share and equity share.
Can you repeat? I could not hear you properly.
Share.
Preference share and equity share. Okay. So preference share and equity share are the two types of shares that any company can issue after registering themselves to the stock exchange. Okay. Now, preference shares are the costlier shares and equity shares are the cheapest in view of investors. Okay. Now, preference shares, as the name suggested, Why this is preference? Because company always prefer to pay first to the preference shareholders. Okay, so let's say company doesn't even have any profit to distribute it to, among the shareholders, still preference shareholders will get a certain percentage of amount just like an interest. Okay, so generally with the name it is suggested that how much they are going to get in return, that is the minimum return. Let's say the name is suggesting that 8% preference shares and the value of one preference share is 100 rupees. That means the company is assuring that even if the company is losing, they will pay 8 rupees as dividend. That is the fixed pay. Okay. And if further the company is doing profit, it is going to be more than 8 rupees. But at any circumstances, preference shareholders will not get less than 8 rupees. Okay. And another benefit to the preference shareholders, if the company doesn't do well and decided to close down, on that case also, preference shareholders will get priority on repayment of their investment. So the shareholders will get their amount back. Okay, so that is why preference shareholders are the safer investors. They get at least something even if the company are in a huge loss. All right. But at the same time, preference shareholders are not the owners for the company. They are not the decision makers. Decision makers are the equity shareholders. So if you are buying a hefty equity shares, you can be a member of the company. Okay, equity shareholders are the owners for the company. They are known as the owners for the company because they are contributing to the equity. Now, equity shares are riskier shares because it is cheaper. At the same time, there is a huge risk involved with this kind of shares. Because if the company is not earning well, the company is not going to pay you. Oh, all right. So they are not going to pay you anything. So loss, no payment. No profit, no loss situation, no payment. A little profit, it is the company's discretion whether they will pay you dividend or not, or how much they will pay you. Only if the company is flourishing, then only equity shareholders will get a good return. Okay, so it is the company's discretion how much dividend they are ready to pay to the preference equity shareholders. So equity shareholders are risky in view of investment. At the same time, equity shareholders are cheaper, so anybody can invest. At the same time, if the company is doing well, equity shareholders has an opportunity to get a hefty amount as dividend. And at the same time, the equity shareholders must be always ready to bear the losses with company. I hope I am clear with my explanation of preference share and equity share. Okay. There is one more question from previous experience using the exam software. It was impossible to draw a table using the software. So, don't you have the written examination? If you don't have the written examination, that means you won't be asked to prepare any table. Rather, maybe some missing figures will be there, or maybe some interpretation can be asked that in this particular case what will be the formula, or whether it will be a plus figure or minus figure. That way the question will be asked. If your examination pattern is online, then you are not going to ask to draw the diagrams. So if you are clear about the thought, you will definitely be able to answer on that case. Okay. So maybe on that case, you don't need to draw any format manually, for sure. I am showing you so that you can interpret the data. On that time, they will write the data and you need to interpret whether plus, whether minus, what is the this, what do you understand about cash flow statement, what it speaks about, if there is an increase in debtor, what is the arrangement, if there is a decrease in current assets, what is the formula. These kind of questions will be asked on that case. Okay, any more question? Any more questions? I am clear. Sylvester is saying clear. Any more question from other students?
No question, ma. Think we
No
have. This
question.
is okay.
Okay, Anas is saying we even made a complaint on drawing tools last semester, but no change or response from the management. In which subject? Which paper you asked to draw diagrams?
We have MSc 213, I think, and
Mm-hmm.
also most of the math questions. We were asked to draw some.
So do you write your papers online in the
Yes, ma. We
system?
write on our system online. Yes, our exam is online.
Okay, your exam is online. But on that case, what I feel that in case of this paper 225, there is no diagram now, only the tables or formats. So that can be manageable. And whosoever is evaluating, they will also understand that a certain gap may be present if you are appearing for online. And I don't think that they will ask you to prepare the entire balance sheet on that case. And even if they are asking, as much as the table is possible, you can do it. Otherwise, you can just simply write the statements. That will also be enough. But you should once again write that this time there should not be any mistake of that kind. That is another difficulty, I understand. You can write for that.
Thank you very much, ma.
Thank you.
So
So,
my,
see you
my, my next
tomorrow.
question, ma, sorry. Is typed assignment uh accepted or only written assignment?
Written, handwritten assignments.
Okay, so once you type your
You are
assignment,
expected to write. You are expected to write on your own.
okay, ma. Thank you very much.
Okay. Thank you. Any other query? No queries. So, okay, I am winding it up here. Tomorrow, see you at 2. Okay?
Thank you very much, ma.
Thank you. You can write to me in case of any difficulty at later stage also.
Okay, ma. Thank you
Thank
for
you,
your time.
Sylvester.